Thank you, Deborah, and thank you everybody from the fixed community and all our non-members joining us today for the panel. It's great to have you here today. Traditionally, as you know, we normally would be meeting in person in Boston at State Street, and Dan Morgan, who's on the line, thank you normally for hosting. But thank you also for your continued support as we've moved the physical meetings we host twice a year, one in New York, one in Boston, then smaller meetings in Chicago around the different regions to a virtual setting like today. We've moved to that virtual setting this year and have had a extensive curriculum monthly to have the fixed trading community come together and bring its participants and non-participants together to talk about really important areas of focus for us in financial services and how FIX is evolving and coming into the ecosystem and helping us solve problems today with respect to what occurs through a full life cycle, a full investment life cycle, and where then FIX is used to apply and being applied to help us solve discretionary and non-discretionary areas of focus. I'm going to hand it off to Tom Jordan. Tom's going to take us through today and moderate the panel. We have a great panel, a great group. And Tom, with that, I'll hand it off to you. And we'll look forward to hearing more about different panels throughout the year into next year, and then hopefully be back together in Boston at some point in time in the future, maybe this time next year. Tom, thank you again, and back to you.
Okay, well, thanks Lou, for that. And more importantly, thanks to you and BlackRock for your leadership, and Amiko Komoda, your co-chair, who runs the America of Goldman Sachs, and the leadership in terms of, as Lou said, expanding the overall use of the FIX, because we're all under pressure to get more efficient, and FIX is helping going through the full life cycle, as Lou talked about, and into different asset classes. So thanks to you and Amiko for that leadership. Also, thanks, as Lou said, to the attendees today, both the FIX members and the guests. Deb set it up at a convenient time, 8 a.m. East Coast time, so that people from Europe could participate. A lot of folks on from Europe. Also Asia Pac, and Asia Pac actually has a 5-day virtual summit going on right now. I called in the other night too, and it's really excellent. There's 3 more days, so if you're interested in, if you're really want to know more about this stuff, right, and you have nothing to do at 9 or 10 o'clock tonight, and you're in the U.S., you'll be able to call in, and that's all on the Fixed Trading website. We run this, all our panels, according to Chatham House rules. What that means is that you cannot quote any of the speakers without directly addressing them and asking them if you could, and you can just send a note to the Fixed Trading office if you want to talk about that. You'll have an opportunity to ask questions today. On the bottom of your screen, you'll see Q&A, and we really encourage that, because we're going to be talking about outsourced trading, but there's a lot of elements to it. So please put questions in at any time, and then Deb will pass them on to me, and we'll answer them throughout the session. So the topic is acceleration and consideration of outsourced trading. A lot going on: regulation, transparency, technology demands are increasing. Not to say anything about the coronavirus in terms of the working from home. So we're going to talk about all that today and how it has impacted the outsourced trading focus. We got a great group of panelists here today that know an awful lot about this. But having said that, let me just ask each one of them to introduce themselves and to tell the audience what do you have to do with outsourced trading? Why did the fixed trading community ask you to be on the panel? Jack, can we start with you?
Absolutely, Tom. Thank you. Good morning to everyone on the panel, Tom, Deb, and to the folks who have joined us this morning. Thanks for taking some time out, and hope that everyone is doing well. So my name is Jack Polina. I work for Virtu Financial. I have been involved in the commission management space, as well as various different product groups within the firm for now 23 years. I got involved in outsourced trading about 2 years ago now, just about 2 years ago. And it was basically on the heels of demand from some of our clients, and our CEO, Doug Sifu, and Steve Cavoli, who runs execution services, asked me to put together a team to give a true outsourced trading solution to our clients. And we entered the space a little differently, I think, than some of our peers, simply because for us, it was more about being more of a backup to our existing clients and giving them an opportunity where they were overwhelmed at times. We have offices throughout the globe. So we have a trading desk in Asia, in Europe, in Canada, here in the US. So we were able to basically take folks internally and repurpose them and build this solution by coming into it with a relatively low opportunity cost, but also with a focus on how do we become more of a backup to our existing clients. Obviously, if somebody needs a full solution, we offer it. And also we own a whole bunch of technology that we felt that could be leveraged as well, from owning our own execution management system. We run our own fixed network, as you know, Tom. We're one of the largest TCA providers, and then leveraging that against our commission management business, we felt that we can add some value to our clients and workflow solutions. So here I am. That's how we got involved, and it's been almost 2 years now.
Dan, can we go to you? Unfortunately, you can't see Dan, but you'll be able to hear him. And hopefully, as Lou said, we're back in State Street next year, and you'll be able to see Dan in person. Dan, can you give a little on your background?
Sure. Thanks, Tom. And yeah, I very much look forward to hosting this event in person next year as we hopefully get back to normalcy. I just want to thank you, the fixed trading community, all the folks that dialed in today, my fellow panelists as well. A little bit about me. I currently run our global agency trading business, which includes many different products, including outsourced trading. I'm a 20-year vet of State Street. I came originally to State Street from the buy side in fixed income trading to start an electronic bond trading system about 20 years ago. It was a little ahead of its time. And over the years, I've been involved with various brokerage products across asset classes. I took over the agency brokerage business about 3 years ago, and from an outsourced trading perspective, it's something that State Street has offered, both on an informal and formal basis for a number of years. As many of you know, State Street is a firm that offers many different products to many different types of customers: asset owners, asset managers, foundations and endowments, sovereign wealth funds, insurance. We offer asset servicing, asset management, and access to liquidity and insights through our markets business. And, we've really seen the maturation begin to happen in the outsourced trading business. We're talking about a business that's been around for over 20 years in some way, shape, or form. Various constituents in terms of client base and service providers, from investment banks like myself, specialists, brokers, and a bunch of firms in between. So we really see the continued maturation of the outsourced trading product really moving from its roots in the small hedge fund community, really evolving into the long only investment management space. And that maturation, I think, certainly began and accelerated quicker in Europe, but that trend is certainly starting to eclipse across the globe in the Americas, as well as the APAC markets. So I'll stop there.
Great, thanks, Dan. Speaking of Europe, Gary, can you introduce yourself?
Sure, thanks, Tom, and thanks for everyone for finding time to listen this morning. My name is Gary Paul, and I run Northern Trust's outsourced trading business, which we call ITS, and that stands for Integrated Trading Solutions. It's integrated insofar we don't just provide for execution services, but we also connect into other Northern services to provide further downstream functions like matching, settlement, swifting to custodians, access to commission management, trade cost analysis, and things like that. We started the business just over 3 years ago in London. We now have about 65 clients on the platform, about 350 billion of funds under execution, and we service a variety of different styles and strategies in equities, fixed income, and derivatives. And as Dan mentioned, there's perhaps a greater focus on the long-only community than the hedge fund, certainly the startup world. Just by a little bit of background as to me, which I think helps contextualize how we ended up in this seat. But my background is I co-founded a brokerage that Northern bought about 4 years ago. And in my old life, I was a strategist or a research analyst, where I once got paid for selling stock ideas to clients. At least I did until MiFID came along. And my job now is really finding solutions to the growing list of problems facing our clients, which I'm sure most here will agree is a growing list indeed. And we're often asked what Northern Trust was doing buying a brokerage at the top of the cycle, just months ahead of the most transformative legislation or regulation in our sort of recent history, which was MiFID. And I think the answer to that is Northern, like a lot of other firms on the panel, in essence, trying to find solutions to the problems of clients. And as clients back then were faced with the changing direction in terms of margins and margin pressure, and as Northern had already helped remove costs from the back and the middle office, the front office was the next logical destination for cost reduction. And so buying expertise in that space made a lot of sense. So hopefully, Tom, that's enough by way of context for why I'm here.
Okay, and I can tell you it's not going to be as exciting as we had our prep call. Gary's fourth child had her fourth birthday party, and she joined the video call, and it was really, it was more interesting than watching the 4 or 5 of us. But Gary assured us that she's not going to be joining us today. So, but that's it'd be great if she does. Gary, James, what is your background?
Yeah, thank you, Tom. Thank you, firstly, to the fixed trading community for including me in this panel, and to my fellow panelists. And for all of you out there for taking the time out of your day to listen to us. My name is James Crouch. I've been at Morgan Stanley for 15 years. Unlike my fellow panelists, my background isn't in trading, it's in equity sales. I'm currently running our global commission management team. That is the team within Morgan Stanley that's responsible for onboarding the client outsourced trading relationships and managing those relationships. Our engagement with the OT space really revolves around new hedge fund launches, predominantly, where we've seen significant growth in the use of outsourced trading firms. And we can talk about why that is later on in the discussion. But I see our team's role as really twofold. One is to fully understand the different outsourced trading models that exist, of which there are many, so that when clients are asking us about the options available to them, we can give a decent accounting of what's out there and how the models differ. And then secondly, we think about this really just in terms of positioning ourselves in order to maximize the revenue that our clients pay us. We obviously provide advisory services to many of the clients that PB with us, and by engaging with them where they want to meet us on the playing field through outsourced trading, we feel that that's most beneficial to our ability to maximize our commission share with them. So I'll leave it there, Tom, and hand it back to you.
Great, thanks, James. Deb, can we put up the first polling question? As I mentioned in the intro, we want to get you involved by Q&A, so please at any time. And we'll have one polling question, maybe two. All right, so we'd like all of you to select on this. The global trend has accelerated. In your opinion, which of the following is the major driver? Cost savings, regulation, technology, incremental trading resource, or you just don't see any growth in outsourced trading. And it's like the college boards. Maybe there's an answer that you have that is not on there, but take the one that's closest to what you think is the trend. So if you could vote now. Okay, so cost savings at the top. Wow. Technology, incremental trading, and there's 6% that doesn't see the growth, and 13% regulation. So let me ask all of our panelists actually, what do you think? Does that surprise you what it said, or more importantly, what do you think the is the major other major drivers. Gary, let me start with you, please.
Sure, Tom. No, that doesn't surprise me at all. It's pretty consistent with what we see and hear, especially in Europe. I mean, cost savings, particular margins, are always a factor in any outsourcing wave, but especially now, as it seems that some of the cyclical drivers of strong markets have stopped masking some of the more structural elements that are underneath. And what I mean by that is the work that we looked at last year with certainly a number of US listed managers actually saw margins decline, even though the market rose. And I don't think that's happened before, suggesting that the economics of the model might be starting to change. And if the economics are changing, then clearly the operations will most likely follow. And then the structural drivers that you mentioned, like technology, regulation, are very obvious. Competition from passives is quite structural too, and I would also add asset owner insourcing as another threat to investment managers. And the weight that you place on each of these drivers depends on the region you're in. So, for example, I'm in Europe, I'm in the UK, and regulation is probably the most dominant factor, up there with cost pressure. And I think this explains why the UK particularly is further down the road when it comes to outsourcing. But I think the ultimate outcome for all regions is the same. It's just that we're likely to reach that destination faster in Europe. It's a case of we're all on the same road, but we've got a faster car. But I think what's really important is, despite Europe being seen as the hotspots for all these regs, it's important to remember these are just European remedies to what are, in effect, global problems. And whether APAC or America imports these solutions, it doesn't alter the fact that these problems still exist and still must be solved for. So whether you're a fund investor in London or in Sydney or in New York, you still want to know you get value for money, you still want to know you're being treated fairly, and you still want to know who to call if there's a problem. So transparency, fairness, accountability, they're the cornerstones of good governance anywhere you happen to be in the world. So regulation's a really big driver, I think, particularly from the UK, but I suspect that will in time be a driver elsewhere as well.
James, what do you think?
Yeah, I agree with Gary. I think our observations are variations on these themes. One is the fact that over the last few years, new hedge fund launches have tended to be smaller, which has made it easier for the founders of those firms to push off the hiring of an in-house trader from being a day one decision to a day two decision, which is obviously related to the cost savings point that you mentioned on the poll. The other thing that I think has contributed to the growth in outsourced trading is just the market environment we've been in. For many years now, we've seen very low volatility. We've seen very concentrated market leadership. And I think that's made it harder for in-house traders to actually contribute to the alpha generation of a fund, which again has created an environment that's made it easier for the fund founders to consider outsourced trading as an option. And it'll be interesting to see if current levels of volatility persist, whether that slows down the adoption of outsourced trading. My sense is it probably doesn't, but I think that's also a contributing factor.
Thanks, James. Dan, what's your point of view on what our audience said about cost savings being number one, and then regulation and technology being a little bit behind it, quite a bit behind it?
Sure. Yeah. Thanks, Tom. I think the results don't surprise me. With respect to regulation, I think MiFID certainly put Europe in the driver's seat in terms of compliance with more stringent regulation. But I think we're seeing firms across the globe that expect to have a client base in Europe, as part of their global strategy, are often adopting their compliance regimes to fit that MiFID II compliance and that profile. So while it may not be prevalent for investment managers that may or may not have a have a home bias in terms of their investment strategies. I think the regulatory component, if it's not there already for a firm, in terms of dealing with European regulation, it is certainly at the forefront, particularly if they want to deal with European clients. I think folks are, a lot of folks are looking for a one-stop solution in terms of a solution that is available after the investment decision is made. And quite often from an efficiency perspective, outsourced trading providers can provide that, sort of one-stop shop for, everything after the investment decision, from the execution to the transaction cost analysis that goes along with proving that execution is good, to the middle and back office component of making sure that transaction flows all the way down unencumbered and settles properly.
Jack, what do you think the drivers are?
Tom, I won't dispute the fact around costs, but I think in speaking to the buy side folks that I've spoken to, it depends on what it is that you're looking for. If you are looking to divert some of the cost of running a trading desk, then obviously, yes, that's going to be a largest factor. But if it goes back to, am I looking to outsource my full trading solution, as well as clearing and settlement and all the analytics that go along with it, or am I a trader? And am I either sitting at home, or am I single trader at a hedge fund, or a part of a group at an asset manager, whereby we don't want to put in the resources to build a desk in Asia, or we need help after hours, or our expertise is not in small and mid cap names, but our expertise is in large cap names. So do we hire another trader just to handle the few, as James put it earlier, volumes aren't what they used to be. So do I hire a trader just to handle small and mid cap names, or do I put that resource to an analyst instead and outsource that portion of my trading desk? So there are different drivers and reasons why people take on an outsourced trading desk. And I think every single one of the choices that you gave are relevant, depending on how you look at it, and depending on who the asset manager is and what their needs are. So yes, I don't dispute the cost savings as the main driver, but there are different reasons for everyone, depending on what region you're in, what type of asset manager, what size you are, and what your trading styles are, and where your investments are, if you're global versus regional, and so on.
Thanks, Jack. Yeah, so lots of factors, and depends on who the customer is and what services you provide. How has the coronavirus, the whole working from home scenario, played into the outsourced trading decision models? Anybody?
Tom, I can have a stab at that. The way I think of COVID and the pandemic is, I don't think it's been a change agent per se, but I think what it has done is it's acted as an accelerant to a lot of these other drivers and changes that were already happening. In particular, as it relates to margin pressure, I think asset volatility that has come from the pandemic can really expose a cost base, and I think as you highlighted, costs are a factor. The other area where I think it really has a role to play is around the issue of governance as it relates to operational resiliency. So again, I'm in the UK, and the regulator is very, very hot at the moment on operational resiliency, but that's not just the UK thing. Every regulator world over, not just the regulator, but the investors as well, is really focused on operational resiliency. And what I guess I mean by that is disaster recovery and business continuity. And when you think of disaster recovery, the past will inform the future. And until now, we've never really dealt with pandemic. So what everyone, no general wants to fight the last war. So what everyone's doing now, be it remote working, work from home, remote surveillance, all that sort of stuff, I think on a go-forward basis becomes base case. And what does that mean? It just means an awful lot more cost and complexity at a time when, as we've just discovered, costs are trying to be mitigated and efficiencies are trying to be streamlined. So that's where I think COVID has really had a role to play. It's just adding another layer of cost and complexity at a time people are trying to move the other way.
Other observations?
Yeah, Tom, it's Dan. I think I think the folks on the sell side have done a remarkable job at resiliency in this COVID environment. I never thought there would have been a time where most of the sell side was dealing from remote locations, either a disaster recovery site as part of a continuity plan, or completely from home. And obviously from a regulatory perspective, the stringency of the supervisory functions that the sell side needs to perform on its dealers and its dealing desk certainly haven't waned, and the regulators expect to have the same supervisory functions and structures and governance in place, as if these traders have been in the office. I think from the buy side's perspective, they've been somewhat more accustomed to transacting from home, whether it be portfolio managers generating ideas and orders from a remote location, or even the dealers themselves, particularly ones that trade off sort of home hours, are certainly used to dealing from a remote location. But I think the dynamic of the portfolio manager working for the most part with a remote trader is something new, and it's something that portfolio management teams have grown more comfortable with as the pandemic has persisted. So thanks. I'll stop there.
Yeah. So will that continue? Do people think once we get out of this situation?
Tom, it's Jack jumping into that. I think to some respects it will. We just recently did a buy side survey, and we found that on the specific questions we asked around COVID specifically, I think the portfolio managers were probably more impacted during COVID than the trading desks, simply because of the fact of access to a research analyst and one-on-one meetings and so on that they rely so much on in their investment decision making, that definitely suffered more so than the trader. I was pleasantly surprised at the fact that at least the clients that we interact with, not so much from an outsourced desk perspective, but from a direct trading relationship, that they didn't have any disruptions in their services. So I felt that they might have needed more outsourced resources in COVID, but thankfully for them and for all the industry, they handled it pretty well. I think where they needed help more so was in the backup scenario or regional, because one of the things that I'm sure everybody on the panel and everybody who's dialed in will say is, while it's been great working from home, we're all working a lot more hours, just simply because we're just always on. And so having that person who can help you in the middle of the night has definitely been helpful for the folks on home with COVID. But I do believe the work from home scenario, whether you're the sell side or the buy side, will continue in some form long term. I look at our firm as an example, and we're not going to bring everybody back. It just doesn't make any sense to anymore, either because you want to remove them from a commuting situation that they may have had 2-hour commutes, and now you're going to have more productivity from them and make their lives a lot easier. But also from an economic perspective, we just talked about the fact that cost is the biggest driver for outsourced trading. Well, what we're learning now is cost is going to be the biggest driver to keep people home. There's a lot of real estate costs and other costs that go with having everybody in the office. So I think that's going to get viewed a lot more carefully.
All right. We're starting to get quite a few questions in. So in between the questions we were prepared to talk about, I'm going to start throwing in some questions from the audience. How do you think about best execution and non-directed order flow? Under what circumstances would it make sense to send orders to a payment for order flow firm? A little bit of a slant on it, but who would like to answer that question?
I'll do my best. I'm not actually on the desk. Full disclosure, I'm just the figurehead, if you will. No, but that said, I think when it comes to the traders on our desk and how they handle order flow and decision making around best execution, I always say, we run an institutional brokerage, and so it's no different than when you're handling a direct client's order that you're executing internally at your own firm, as with an outsourced situation. So we have various procedures that we have to handle. We have order handling rules that we're working under. And if there's liquidity, ultimately our job is to find liquidity and to provide a service to our clients in the best way possible. And BestX is, Dan mentioned it earlier, providing a TCA solution around what you're doing as an outsourced trading desk is important, and being able to show that no differently than if you're running a desk internally. You have to be able to show investors BestX. So it's the same workflow for us. And, there's no difference in order handling rules from a direct trade to an outsourced trading order that we have to us.
So, Tom, I mean, I echo a lot of that as well with how we view it. It's a question that comes up a lot. The way that we address it is just to remind our partners that we have no avenues or even potential avenues to contaminate flow, which I guess a lot of agency operators could say the same. Yes, we deal inflow from different sources, be it our outsourced clients, our transition managers, or indeed our institutional clients. But we only act ever as an agent, and we only ever act on instruction. And we're under strict obligation to treat those clients fairly, irrespective of where they come from. And we certainly don't distinguish on size. And again, if clients are concerned, then we'll work with them to find solutions. Perhaps we ring fence that flow and we direct orders, which is conceivable. But of all our clients on the platform, none have gone down that route. They've all preferred to avail themselves to that unique liquidity, which is one of the characteristics of BestX, is having access to that liquidity profile. And then, of course, as the previous speaker mentioned, we subject ourselves to external scrutiny by way of an independent TSA. So we're not marking our own homework, but we've got someone doing that for us. So that's how we address it. But it's certainly an issue, and I think it's really important that the communication between the vendor and the client is such that those issues are dealt with at the outset.
Okay, thanks. There's a lot more questions coming in terms of the services that you offer in terms of an outsourced service, right? It could just be the execution itself, regulation, compliance. What are some of the services that people consider in terms of selecting an outsourcing partner?
Tom, it's Dan. I'll take a stab at that one. The possibilities are vast in terms of what an outsourced trading firm may or may not be able to provide. But small punch list. And Gary mentioned it earlier. Commission management services to satisfy the research commitments for the particular investment manager, whether it's directed flow to a provider that is providing those research services, or commission sharing or research payment account type arrangements. Full transaction cost analysis that fulfills the obligation of proving best execution, and most appropriate from a third-party source. In comparison to an in-house source, although some in-house sources are absolutely relevant to a particular asset manager. firms have the potential to provide downstream middle office services. Think investment book of record, something that State Street provides, as well as even on the front office, some firms are able to provide full portfolio management and order routing functions to allow the order to go to the outsourced trading desk. And I think it's key for firms to be able to offer a modular solution where they don't necessarily have to take the full package, the full front to back. They may want to use their own order management system and they may be happy with it. Or they may have their own sort of downstream middle office capability that they're very pleased with keeping. So I think it's key that the outsourced trading firm have flexibility in terms of solutioning their client to design a solution that meets their needs.
And Tom, I think Dan's commentary kind of speaks to the breadth of variation of demand for outsourced trading services. I mean, that's something on the sell side we definitely sort of struggle to. Well, we need to make sure we fully understand is how our clients are wanting to engage with the outsourced trader. And that's important from an operational perspective for us to try and sort of limit the operational drag on the trade flow. But I think there's a whole breadth of different levels of service that are provided by different firms, and that's one of the complicating factors.
All right. Thanks, James. Thanks, Dan. Another question. Has the shift in technology at the buy side from enterprise installed to a less IT-heavy infrastructure, software as a service, in other words, software as a service, maybe even running in the cloud, affected the adoption of outsourced trading? So has the whole trend in terms of technology from, using, my own stuff in-house to an outsourced service affected the adoption?
I could take a stab at that, Tom, if you wish.
Great.
It's a great question, and I think it's actually touching on where certainly we see the future of the asset management industry heading. And you use some of the vernacular that is more common in technology, and I think the journey that the IT and technology sector has been on provides a great analog to where we're heading. And I think Dan sort of talked about this in his previous comments. But when you think about an IT company, what many do is they in-house the IP, and then they outsource all the high capital intensive, lower value added parts to hyperscale providers like a Microsoft or an Amazon. And in much the same way, we see a lot of asset managers now are looking to do a very similar thing where they want to in-house what they've defined as being their core value proposition, which is their investment decision-making process, the systems and the people that go into supporting that, obviously the management, the control, possibly the distribution as well. And then they want to outsource a lot of the high capital intensive, low value added parts to a consolidated vendor who can provide those services at scale. And so what Microsoft might be to IT, I think asset services start to become looking like that to IM, to the investment managers. And in that sense, trading becomes more of a service, like software as a service, where the idea of having to carry the cost and complexity of a function itself, if it doesn't add value, and don't get me wrong, for some firms it does add value. So it's just in those where it doesn't add observable and evidential value, that there may be now a better way to free up that capital to invest in more higher return pursuits and move those fixed costs onto a variable cost basis, which is the direction of travel, we think, for fee revenue. So great question, and I think it actually touches on where we're heading in the future.
That's great. Yeah, and there's plenty more. Let me just ask you, in terms of the clients, I mean, a lot of you people are explaining why outsourced trading makes sense, and it doesn't have to be everything; it could be part of it. What's the biggest objections that you hear from your clients? Right? I mean, I used to I used to be at IBM a long time ago, back when they were like Microsoft, right? On that. And they used to say, well, the sale really starts when the objection comes on the whole thing, right? So what are the objections that you're hearing from from your asset management client?
It depends on who you, it's Jack, Tom. It depends on who you're speaking to at the asset manager. If it's the trader, obviously the biggest question is, are you trying to put me out of a job? And it goes back to the approach and what the needs are. Now, if the portfolio manager is going to replace that function, it's out of our control. If on the other hand, we talk about workflow solutions. I always say everybody's trying to keep their job, regardless of whether it's me or the trader or the portfolio manager. So how do you help somebody keep their job? By helping them do their job better. So for us, it's more about how do I, not us, and I say use the term us, I think it's for everybody here on this panel. It's how do we help, whether it's the portfolio manager or the trader, do their job better? And what tools can we give them? What access can we give them to liquidity or regional access? How can we help them do their jobs better? And so that's what it's all about. I think the DDQ questions have gotten a lot better than they used to be, 3 years ago. Portfolio managers are very in tuned on what are your controls, what are your risks, who do your traders report to, what type of compliance controls are around checking what they do and so on. Do they live in the same home? All this good stuff. There's a lot of great DDQ questions that come through today versus a couple of years back. So, but the single biggest pushback, I think, from a trading desk is obviously what we're trying to accomplish, and will that ultimately mean that they're out of employment? And to the portfolio manager, I believe it's more about what types of risks and controls do we have around protecting their orders, protecting their order flow, and information barriers and so on. And I think that's why it's so important to have a separate broker neutral business if you're a large firm like some of us here, where there are other business lines versus just a standalone product.
Anybody else want to say what their experience has been?
Just to add to what Jack said with staff reduction, he is absolutely right. That's one of the most obvious and key concerns many people have when they see the outsourcer coming. But I think just a couple of things to say on that is, a lot of what we're seeing is a natural consequence of the technological evolution or disruption that's under the industry is undergoing, which it essentially is. But what I would just add, and this is from our observations in the UK, is good people don't always lose their jobs. So when a firm questions what is core, which a lot of them are now post-COVID, they've all gone Control Alt Delete, what's actually core to what we do, and we double down on that, and what's not core as a cost, and we might look to outsource it. But they're all asking that questions. What I think is really critical for firms to do is to distinguish between the dealing process and the people performing that process, because they're different things. And while some might think the process might be redundant, the people may not be. Those people might add value in different roles. So it's kind of nuanced. It's less about staff reduction, and often it's more about staff repurposing. So for example, we've seen a lot of instances where the head of dealing has become the head of vendor oversight, for example, because he or she has got a really good insight into that process, is well placed to push back on the vendor to ensure they do a really good job. But they're also a great conduit to investors and to regulators to help describe and articulate best execution. So it's not like outsourcing of old, which was displacing the same unit but at a lower cost. It's more nuanced than that, and it doesn't always end in staff reduction.
Yeah, Tom, it's Dan. I mentioned before that this product was maturing, but by no means is it mature. And I think many in the marketplace have scratched the surface in terms of what outsourced trading providers can provide. But in a sense, it's a new paradigm And quite often, if you're asking a chief operating officer, about pain points, we mentioned cost and and outcomes. So the result has to be improved cost, as well as better outcomes. And certainly from a portfolio manager's perspective, the experience of having a dealing desk or augmenting a dealing desk has to be consistent, if not improved, relative to that portfolio manager's interactions. Right? These decisions, certainly for investment managers that are somewhat newer to the concept, are not quick decisions, and somewhat different than the traditional broker asset management firm interaction, where you're onboarding a dealer. That's a relatively quick process. But if you're considering an outsourced trading assignment, whether it's augmentation or complete outsourcing, that is a journey in terms of education for that chief operating officer and his portfolio management and other staff. That the experience is going to be comparable to better to the experience and outcomes that they're having right now.
Thanks, Dan. We're actually out of time, and we have about 10 more questions left. So I'm going to stop there and thank the panelists, but also ask the panelists to work with us on answering these questions after the Deb and send over the questions to you, and we'll get the answers back to the people that are attending the conference, because they're really excellent questions, and it just shows the the importance of the topic. So we'll do that, and we'll send answers back to those questions, because it's pretty broad in terms of the questions, in terms of trading, liquidity, fixed messaging. So we'll go ahead and we'll do that. So with that, if I can thank the panelists again, wish them and everyone happy Thanksgiving, but turn it over to Kathleen Callahan, who's the operations director for Fix, who can close us out. Kathleen?
So thanks to the panelists. We appreciate your perspective and expertise on this topic. It was a really educational session, helping everyone to understand the drivers for outsourced trading as we watched evolve within the respective regions. So as you can see, Deb's got up a slide of initiatives going on. These are some of the active working groups within the fixed trading community. As you know, Fix is focused on collaboration, bringing members of the community together in a neutral environment, addressing topical issues that impact our member firms. And as you look at this list, if there's anything you're interested in participating in, we encourage you to contact the program office and be asked to be added to the group. So I'm just going to go through and highlight a couple of the groups we have here. The execution venue working group is focused on providing consistency on how brokers report to the buy side with the information in tags 29, 30, and 851. This group is going to start looking at improvements for tag 851. The orchestra working group, this group is developing the orchestra standard, which will deliver machine readable rules of engagement. We'll also be offering some member tools that firms can use to help along with that standard. And then we also have the life cycle and ecosystem working group, which is looking to identify inefficient segments within the trade life cycle and create connections from front to back. So again, there's a lot going on in Fix right now, and so we would appreciate everybody's participation and background and knowledge on any of these topics. So contact the program office at fix@fixtrading.org. So we're just going to go to the next slide and Deb will show the events that are coming up. As Tom mentioned earlier, the Asia Pac Virtual Trading Summit is going on right now, and so you can go to the website and link in there, and depending on where you are, different times of the day for you, but that will go through the balance of this week. On December 2nd, we have the impact of automation and COVID-19 on workflows. On December 9th, the Latin America webinar. This is going to be a number of CIOs from some exchanges in Latin America, and they're going to talk about the current climate trends and forecasts. So you can sign up on the website for that webinar. And then finally, to close off the year, we have the EMEA Fix Next Gen networking event on December 10th. So again, the URL is right there on the website. Go to the events page and you can get updates and sign up for those events. So I'd like to just say one more time, thank you to our panelists and to the audience. This will wrap up our session for today, and stay safe, everyone.